C3.ai, ticker symbol AI, has recently surged and then fallen by around 14.13% compared to Palantir's loss of only 3.29%. So we'll get into why that is. C3.ai has received a lot of hype lately, but investors really don't know what to make of this company. Both of these companies represent two different plays in the AI space, and when assessing the artificial intelligence software market, we need to understand that not all artificial intelligence companies perform or even do the same things. For instance, C3 develops AI algorithms that can be integrated with an organization's or a company's existing software. Their AI algorithms will be used to do things such as automating mundane tasks, improving overall employee safety, trying to cut losses for the company, and detect fraud. Now, there is overlap here because Palantir Technologies can also do some of these things. However, Palantir's platform is mainly used to accumulate large amounts of data, interpret that data, and then inform the leadership of that organization to make data-driven decisions, thus leading to potentially cost savings and higher revenues for that company. But why has C3's stock absolutely surged over the last few months? Well, the reason for this is that, one, C3 has landed a plethora of various customers to where now they are serving around 236 customers for a particular quarter, and these customers primarily are involved with either energy, industrials, or government markets. But it also generates a third of its revenues with a joint venture from the energy giant named Baker Hughes. Now, this is, again, another double-edged sword, because we don't want a company that has 1/3 of its revenues reliant on just one single customer, because if this customer ever decides to replace C3, or their contract ends, which it will at the end of April of 2025, this could negatively impact C3, especially if this giant company does not renew their overall contract, which is why C3.ai has been signing deals with Alphabet's Google Cloud, Microsoft, Raytheon, the United States Department of Defense, and many other top-tier companies. This is one of the reasons that have invigorated investors to cause the share price to skyrocket to where now the current share price is around $22. But bearish investors believe the company is way too overpriced right now, and they should be trading at around $11. On the other hand, we have other bullish investors who believe over the next 12 months that the company could surge to $30, despite a recent cool-off in their share price by around 14%, which you can see on screen right there in that little bubble that I highlighted. Now, the good thing about this company is that they are a smaller company. Their market cap is only $2 billion compared to Palantir's $17 billion. But that doesn't necessarily tell us about the company. We need to look into their growth rates. For instance, the company grew their overall revenues by 38% in the fiscal year of 2022. However, they believe that the revenues will drop to just 1% to 7% growth over the next fiscal year throughout the year of 2023, which is what's calling this pullback in the overall share price by around 14%, and I do think they will pull back even more. Similar to Palantir, C3 also operates off of a subscription-based model. They recently pivoted to that model, and in my opinion, subscription-based models are one of the best models to use across technology products and services. Now, the bad news about this company is that their net loss more than tripled to $192 million. And professionals believe and project that the company will increase their net losses to $304 million throughout the fiscal year of 2023. So it's not good that this company is digging itself a deeper grave by increasing their net losses. Clearly, we would want their net loss to decrease, not increase. Another reason why we saw a huge increase in investors buying C3 is that many investors want to know what are the best artificial intelligence companies to buy right now. To put this into perspective, C3 was on a huge downtrend to where their stock price lost 64% throughout the year of 2022, and then it surged 130% this year for one main reason, and that's because OpenAI's chat platform, which is now backed by Microsoft, which is a C3 partner, they thought that this is going to have very good crossover for C3. However, I personally am not making that connection. They do different things. And it's not like C3 is using this artificial intelligence technology, Microsoft is, even though OpenAI and C3 are both partners of Microsoft. So how does this compare with Palantir and their fundamentals that we previously talked about? Well, in my opinion, and the author of this article both agree that Palantir is not only the winner, but the obvious winner here. The main reason for this is that Palantir not only trades at a better price to sales ratio, because Palantir is trading between a 9 to 10 PS ratio, which is their price to sales ratio, while C3 trades at an 11 times PS ratio. That's forecasted for 2023. On top of that, Palantir is growing faster than C3.ai. So again, not only are they cheaper and a better value, but they are also growing more aggressively than this company. And lastly, Palantir is also not growing their losses as aggressively, making Palantir the superior company in my personal opinion. Palantir just has better growth and it's a more stable company. And I also want to make you aware that because C3 recently rallied so aggressively, investors should not be surprised if the share price starts to cool off even more than a 14% downside. And that's why I think C3's share price will drop over the next month or two. Because as of right now, it is just too expensive from a PS ratio standpoint compared to their overall growth. Now let's talk a little about the macroeconomic environment and how this could positively or negatively impact Palantir Technologies, and then we'll also talk about their earnings report very briefly. So shares of Palantir Technologies have actually gained 24.33% over the past month, which outperformed the business services sector on the stock market, which gained just 7.44%, and it also outpaced the S&P 500, which is a fantastic stock market benchmark of the top 500 largest companies by market cap in the United States, which grew by around 7% during the same time period. So investors are hoping for this positive trend for Palantir Technologies PLTR stock to continue. And with their approaching earnings report, which will be released after market closes on February 13th of 2023, we could get that. For instance, right now it's currently projected that they will report an earnings per share of 3 cents on the positive side. That would represent a 50% year-over-year growth. Now, we do have to compare this with their overall net sales, which are projected to come in at around $505.95 million, which would equate to a 16.88% increase from a year ago. Now again, this 16.88 clearly falls below management's 30% CAGR, their 25% CAGR, and their 20% CAGR. So essentially, at least for this quarter, all three of these projections are going to come up short, which is going to negatively impact the overall share price, but this could be offset from the momentum that we are seeing from their earnings per share, where they grew by 50% year over year. So it's really a positive and a negative here, to where we don't know how the market will react, because it's not like we're going to get good news across the board. It's a mixed bag. And we also don't know what Palantir will actually bring in. These are just projections. So in regards to their revenue, we're not going to have a very positive outcome, but in regards to their EPS, we are going to have a positive outcome. I also want to take macroeconomic considerations as a factor of their future share price, because professionals right now estimate that Palantir is going to experience short-term volatility, which means essentially that the share price could fall further downwards, all the way down to around $5 to $6. The reason for this is that many investors believe, despite the macroeconomics being a little bit negative, Palantir is also trading at a very high forward PE ratio, which is their price to earnings ratio, which currently clocks in at around 54.92. For comparison, if we compare Palantir to their industry average, the industry average's forward PE ratio is just 22.98. Clearly, Palantir is trading at a premium when we take into consideration their PE ratio. So until their overall share price cools off by falling lower, they are not necessarily a good buying opportunity. But wait, there is also the PEG ratio, or the PEG ratio, which comes in at 1.95. Now, what's the PEG ratio? Essentially, the PEG ratio takes the PE ratio on top of the earnings growth projections into consideration. And the good news is that the PEG ratio of 1.95 is actually lower than their overall technology services space in which they trade in, which comes in at 2.34. So when taking growth into consideration, it's not as bad as the space in which they trade, according to some metrics. But again, this is a mixed bag, and it really comes down to just how long you are willing to hold this company as an investor, because they're not supposed to become profitable until the year of around 2025 or maybe early 2026, based off of current projections. So hopefully your average cost for this company is below $10 per share, and you also need to make sure not to overexpose yourself. But in the end, I have a hold rating for this company, and we're just going to have to see what they bring in for their overall earnings report. But I do hope that this company does well, and I would love to hear your thoughts down below. Don't forget to smash that like button if you made it all the way to the end of the video if you haven't already. And if you have liked the video but you haven't commented, go ahead and just comment your thoughts down below. Subscribe if you are new, and I will see you in the next YT video.